Gold has broken $2,900 an ounce. Silver is testing a breakout as we speak. Meanwhile, massive physical amounts of gold and silver have been moving from around the world into New York, into the COMEX exchange vaults, front-running potential tariffs by the Trump administration, which have caused delivery delays primarily out of the Bank of England in London, which has begged the question, is there a shortage of physical gold? Is there not enough gold to go around? In this gold market commentary for Friday, February 14th, 2025, we'll look at the latest charts for gold and silver, and we'll drill down on what's been happening in this massive movement of gold from London and around the world into the New York vaults as Donald Trump continues to announce new tariffs on a daily basis. Hi, I'm Dana Samuelson, president of American Gold Exchange in Austin, Texas. We're a national physical precious metals and vintage U.S. gold coin dealership. We can help you with any of your physical precious metals needs. We'd love to have that opportunity. So let's get into our update. First, I want to go over the latest charts for gold and silver. This is a one-year gold chart, and you can see how gold has moved sharply higher since Donald Trump was inaugurated president on January 20th, as indicated by the number 47 on the chart. It's made a sharp run higher from about 27.50 all the way to 29.42 as of the close in the futures exchange yesterday, Thursday, February 13th. Today, we've seen gold surge as high as 29.60 in the futures market, but we've also had a bit of a sell-off on profit taking today and a weak retail sales report today. So gold, as we speak, is trading around $2,900 an ounce today. It's not reflected on this chart, but this move higher has been sharp and relentless over the last 3 weeks. The same way Donald Trump has relentlessly announced new tariffs on almost a daily basis. Let's take a look at the 6-month candlestick chart where we drill down a little bit more detail of what's been happening. As you can see, during our last update about 3 weeks ago, gold was testing 2,800, and we said, hey, gold's testing an all-time high. We had a couple days where we sold back down, but then gold has taken off. And it's primarily due to the continual drip, drip, drip announcement of tariffs and the different kinds of tariffs that Donald Trump has decided to deploy. That first box that shows tariffs on, tariffs off is the day that Donald Trump announced that the U.S. would deploy tariffs of 25% on all imports from both Mexico and Canada. Now, Mexico exports about 80% of their goods to the United States, which would have been a gigantic imposition on the Mexican economy. So, of course, the Mexican president and Prime Minister Trudeau of Canada came running to the negotiating table and conceded border concessions to Donald Trump, which caused President Trump to say, okay, hey, we won't deploy those tariffs just yet. So that's tariffs on and tariffs off. You can see when just a week later, Donald Trump announced that we would deploy tariffs on all steel and aluminum imports into the United States, including finished goods, that gold jumped about $50 that day, from about $28.80 all the way to $29.30. And that was a big day for gold because of the announcement of new tariffs. We've seen some tentative trading since then. And then, of course, just yesterday, reciprocal tariffs were announced where President Trump indicated that we will deploy the same tariffs on every other country that the U.S. exporters experience as we try to export goods into whatever country that may be around the globe. And gold caught another bid yesterday as a result. So this drip, drip, drip of tariffs has helped to push gold higher because gold climbs a wall of worry. There's a lot of uncertainty on what could happen next and how all this will affect the markets. We also think that tariffs are potentially inflationary in their cost to U.S. consumers. And the U.S. economy is really the only economy that's performing well right now. So gold has climbed a wall of worry over the relentless declaration of new tariffs to protect U.S. industry from exporters dumping goods into the United States at low premiums. So that's what's been happening with gold. Gold looks really sharp. It's getting toppy around here, around 29.50. We're seeing some profit taking today. We're down about 2,900 on the day right now. I do expect gold to see some resistance at 3,000, but right now it looks like we're going to see support kick in at about 28.50 to 28.75 with a ceiling at 3,000. So that's probably the trading range we're going to enter into moving forward. And it looks like 28.50 is going to prove to be a real support level, not much under where we are right now. Let's take a look at silver. This is a one-year silver chart. During our last update, silver was still under that declining blue trend line off to the right, but since then we've seen silver break back up higher, testing that 32.50 upward resistance line, punching up as high as 33.02 before correcting back down a bit. But silver is testing a real breakout over 32.50 right now. And today in particular, we've seen a real big move higher in silver on the daily candlestick chart. Let me pull that up. And as you can see, I have penciled in off to the right in that black arrow today's price movement, where silver spiked all the way up to 34.25 this morning before being sold back down. As I tape this, silver's trading at about 33.80 in the futures markets, 32.80 in the futures market. So it's down about $1.40, $1.50 from the peak today, but that's a real breakout test, a real move higher. So it looks like silver may finally start to realize some of the pent-up price potential that we believe it has within it, and has had as like a coiled spring over the last 6 months to a year, while gold has moved relentlessly higher over that same period of time. So silver is looking very good. Let's take a look at the gold to silver ratio. That's today with gold in the spot market at 2,900 and silver in the spot market at 32.50 is 89.23 to 1. It's very high. It was a little bit higher during our last update, just over 90. So silver still remains undervalued relative to gold, and in our opinion, by quite a long shot. So there's a lot of value to be had in silver, but gold will continue to lead as it has been doing. Okay, that's our update for precious metals. Oh, we've got one other thing. We have a special on 1 ounce US Gold Eagles backdates. All the dates minted between 1986 and 2024 that we can source from the marketplace. We're offering these today at a national low of just $49 an ounce over their intrinsic metal value. This is the lowest premium we've ever been able to offer backdate US Gold Eagles at. And that shows you that there's a lot of supply of gold in the US marketplace. There's not a lot of demand right now from the public, and that has brought the lowest premium we have ever offered on backdate US Gold Eagles. And that's a clue to whether there really is a shortage of gold or not in the world. Now let's get into our details of what's been happening with this massive movement of physical gold and silver into the US. This is a headline from an article that was in the Wall Street Journal yesterday. Why dealers are flying gold bars by the plane load from London to New York. Well, quite frankly, it's because there's been a price differential due to tariff front running of the value of an ounce of gold in New York versus what that same ounce of gold is worth in London or elsewhere. And it's because of fear over what potential tariffs may be brought on precious metals. Now, if gold's $3,000 an ounce and President Trump decides to put a 10% import tax via tariffs onto gold, that would make gold worth $3,300 an ounce in the US, potentially. Now, if that same ounce of gold today is worth $40 or $60 more than it's worth in London or Switzerland or Australia, for the cost of freight, which is not that much per ounce of gold, you can bring it into the US and attain that price differential of $40 to $60 an ounce and have an insurance policy against a potential tariff that might be enacted. And that's a real financial incentive that have caused the big trading houses, JP Morgan Chase, HSBC, Goldman Sachs, etc., to move a lot of physical gold from outside of the US, primarily London, into New York. And the mechanism by which this price differential has occurred is through the EFP, or the exchange of futures for physical. So what an EFP is an ability to swap a contract on the COMEX exchange for that physical asset. So if I own or I'm long a 100-ounce contract of gold for delivery in March on the COMEX exchange, and the price in New York is higher than that same ounce of gold is worth on the street in New York, and you have a 100-ounce gold bar in London, we can swap them in an over-the-counter transaction. And the EFP is differential between New York and London, has been as high as $60 per ounce in the last 30, 40 days. Today, the EFP is about $20 as we tape this. And that's a big incentive to literally move the metal out of wherever it is and into the United States, because the freight and insurance, transportation costs are a lot less than the price differential. Now, if you're JP Morgan Chase, HSBC, or Goldman Sachs, you've got two distinct advantages that people like you and me on the street don't have. Number one, they're banks. So their financing charges, their carry costs are probably going to be advantageous, or a lot less than you and I would pay for the same borrowed money or the same financed asset. And number two, they've got vaults, so they can store the metal themselves. And they've got lower storage fees. So this is a distinct advantage these large financial entities have, and has enabled them to move this massive amount of metal from out of the US into the US, front-running potential tariffs. And the exchange through which most of it has happened is through these EFP swaps. This is a chart from that same Wall Street Journal article that shows you the premium over London for that same ounce of gold in New York. And as I mentioned, the EFP swap differential has been as high as $60. It's about $20 today. You can see the premiums have been higher for quite a while, but they've been excessive recently. This chart doesn't show it so much, but this is what has driven the incentive to move this metal. It's strictly greed. It's profit. We saw a similar phase during 2020 when COVID hit, but for different reasons. This is all front running of potential tariffs and harvesting the price differential between what an ounce of gold is worth in New York versus what an ounce of gold is worth in London. This is an article from mining.com from 2 weeks ago. Nearly 14 million ounces of gold worth $38 billion have flowed into the depositories of New York's COMEX Futures Exchange since Election Day, along with 45 million ounces of silver. And this has been helping to put price pressure into the gold market due to the uncertainty over whether there will be tariffs on precious metals or not. This is a chart that's been going around on social media from Zero Hedge. And this puts into perspective how much gold has moved into the big three vaults of Brinks, HSBC, and JP Morgan relative to what happened during the last time we saw a spike of importation of metal into the US COMEX vaults because of COVID. So let's drill down on this just a little bit. Number one, the period between 2016 and 2019 was a pretty stable period for precious metal sales. The US economy was doing well. Gold and silver sales were pretty good, although declining in 2018 and 2019. And then what happened? Well, COVID hit. And what problem did we get with COVID? Well, we got closures of refineries in Switzerland, which impaired physical availability of gold. And we also had the airlines shut down for a while, which caused delivery mechanism for precious metals to be impaired as well. And we also had a huge surge in physical demand for precious metals around the globe. Precious metal sales in the US exploded in 2020, into 2021, and into 2022 before they finally eased down into 2023 and 2024. So that's why we saw such a big influx then. And now we're seeing another huge influx, but it's not abnormally high relative to what happened in the past. It's for a completely different reason right now. It's a financial incentive that makes sense to move metal into the US if you can do it. And that's what these big financial houses have been doing. And it's caused strains on the system because we're not used to seeing such a great demand for metal to be moved so much so fast, trying to get ahead of when potential tariffs may be announced. So that's what's been happening. And it's unusual, but it's not abnormally large at this point in time. This shows you how many ounces are potentially available for delivery against COMEX contracts. And again, they're hitting highs, but they're not hitting record highs disproportionately larger than previous highs. Not yet anyway. So this is unusual, but it's not abnormal as far as what's happened in the past. It's a manageable situation so far. And here's where a lot of the conspiracy theorists started to shake and twitch a bit. When this first started happening in December and January, and I mentioned it in our last update, a lot of the available over-the-counter buyable gold in London got bought up and brought over here. That strained the supply in the London market. So if you wanted to get more gold in volume, you had to go and ask the Bank of England if you could borrow some or lease it. Now, the Bank of England is the world's second largest depository of gold behind Fort Knox. They've got over 400,000 gold bars in their vaults, and they're all allocated to specific owners. And they're not a fulfillment center. The Bank of England is a storage facility. They're not a shipping and receiving facility. Most of the gold that goes in there stays in there. It trades hands inside the vault, and sometimes it doesn't even move from one position to another position in the vault. It just has a new name put on it. If you and I were to buy and sell it with each other, they'd take my name off and put your name on that bar. So it's like a giant Jenga puzzle in there where finding the right bars can take time and effort. And then there are logistics issues. You know, how many physically can you move in a single day? and there are insurance constraints as well. So when Dave Ramsden, in a viral social media clip in an interview, who is a deputy governor of the Bank of England, said, "Hey, this stuff's heavy. It's cumbersome. It takes time." Some people thought that was a dodge, but this is a real logistical issue for them because they're not a fulfillment center. So the gold is there, it's coming out, and it's being allocated to the shipping slots that they have available, and they're processing it in due course. But what's happening now, and will probably mitigate this situation going forward, is that there's enough of a meaningful delay in getting it out of there, waiting for your queue to get it put in the delivery chute, and getting it into New York. Tariffs could be announced in the meantime. And if that is your goal that you're trying to move now, and you're caught in the queue, so to speak, and tariffs are announced, well, now you're going to have to pay those tariffs on that gold. So you're a loser on this financial opportunity that exists for these big trading houses. So that's probably going to mitigate things a bit going forward, especially now that we've had so much moved into the US vaults. So this is simply a massive metal movement. It doesn't mean that there's not enough gold to go around. And it could go back the other way. That has happened in the past before, but this is the way it is right now. So this is a chart that shows the London Bullion Market Association vault holdings of gold and silver, and it puts into perspective the changes we've seen over the last 7 or 8 years. So you can see as gold moved out of London due to COVID and got sold down in 23 and 24 into 2025, today we haven't seen that much of a drop in physical gold available in the London Bullion Market Association vault holdings. We have seen a much more meaningful decline in silver. And that leads me to believe that, hey, the silver breakout that we're seeing today could be for real finally. We do have a structural physical deficit in silver. We're entering into our 4th year of that, where the world consumes more silver than the mines physically produce. And as you can see, the holdings of available silver are dropping more sharply relative to gold. So that tends to buoy my thought that, hey, silver could be ready for finally attaining that explosive price movement higher that it's been resistant for or towards so far, as gold has moved relentlessly higher in price over the last 12 to 14 months. So I think silver is looking really good right now and potentially could attain that explosive potential that we've been assuming was possible for it. And that brings me to another subject, which is just basic demand for gold. This is a chart from the World Gold Council that has been tracking central bank gold buying going back to 1980. This chart goes back to 2010, when central banks became net buyers of gold for the first time in 30 years following the great financial crisis. I've discussed this in the past, where on average between 2011 and 2021, central banks were buying about 500 tons of gold a year, and how that doubled in 2022 to 1,087 tons of gold following Russia's invasion of the Ukraine and our sanctioning of Russia. In 2023, that figure came in at about 1,050 tons, just under the record for 2022. And we just recently, in the last week, got the final tally for 2024, which was 1,044 tons of physical gold bought by central banks in 2024. 3 years in a row, more than double the previous 10, 11, 12 years. I thought this year's total for 2024 would come in about 950 due to the higher gold price mitigating some of the demand, but that was an understatement compared to what the actual figure has proven to be. So central bank gold buying remains really robust despite gold hitting all-time highs in 2024 and into 2025. But there's more to it than that. China, the Central Bank of China, is back in the gold buying business after taking a hiatus from last spring and summer into the fall. It's reported that they've been net buyers again for November, December, and now January, the last 3 months. It's also rumored that they continued buying when they said that they were not. I can't prove that, so I don't want to talk about that more than just say, hey, it was a rumor. But this is fact. The Central Bank of China has been back in the gold market for the last 3 months buying gold, which is very bullish. And not only China, the world's number 2 most populous country, India, the world's number 1 most populous country, has had record gold imports in 2025, as you can see on this chart, the most ever in the last 10 years. So India is importing gold at record levels as well. The 2 most populous countries are in the gold buying business, and this is meaningful for gold going forward. So this is the most fundamental driver of gold is physical demand, and it remains at record levels among the biggest players in the world, central banks and the 2 largest countries that there are. So that bodes very well for gold going forward. I think gold has potential to hit $3,500 an ounce this year, and this may be the year where we finally see silver at $40 or $45 an ounce, maybe 50, the way this market has been moving. So that's our update. Thank you so much for your time. If you like what we're doing, please subscribe to our channel. Like this video. If you have any comments, I'm happy to try and address them. And as always, thank you for the loyalty and trust that you've placed in us over the last 27 years. Without clients, a loyal business, we don't have a business. And there's never a day that goes by that we don't remember and thank you for your loyalty and trust. This year, excuse me, this year is going to be very exciting and challenging as we get a relentless stream of new economic information from President Trump and his administration regarding tariffs and other major changes. That's why I haven't given any economic information in this because it seems trite compared to what President Trump is doing on a daily basis right now. So good luck. We'll see how these things continue to unfold, and we'll keep you advised. So thanks again and have a great day.